Hi guys, I'm Karunya Rao, and in Ideas for Profit we tell you what makes Adani Ports and SEZ a strong re-rating candidate. Despite hiccups in global trade caused by China and other factors like higher commodity prices, supply constraints, coal crisis and spike in crude oil prices, Adani Ports has reported a good set of numbers with strong performance from the port and other businesses. Moreover, the company maintains its guidance and expects the second half to be even better in terms of revenue as well as earnings. A slew of factors like integration of recently acquired assets, market share gains, higher coal volumes, spurt in cargo business and an economic recovery-led jump in core business should support its strong guidance for the current fiscal year. During the first half of the current fiscal year, Adani Ports delivered a strong 56% year-on-year growth in revenues, aided by robust growth in cargo volumes, which is up almost 47% year-on-year in the first half of this fiscal. The company handled 144 million tons of cargo in the first half compared to 98 million tons last year in the corresponding period. Besides, the company has also gained market share by 144 basis points to 42.5%, leading to higher growth. Ports business accounts for about 78% of its consolidated revenue. The rest of the businesses like logistics and O&M business saw marginal growth. For instance, logistics business benefited because of strong uptick in volume as a result of pickup in economic activities. The company added 8 new bulk rakes, taking its total to 69. O&M business is relatively small, but that too saw a good 11% YOY growth in revenue. Higher scale and volume in the port business along with the decent growth in other segments as well helped the company improve its profitability. Operating profits improved across ports led by higher volumes and improving efficiencies of these assets, particularly the ones that were recently acquired. Its port business on a consolidated basis recorded marginal improvement in EBITDA margins to 70.2% in the first half of FY22. Now, last quarter, the company revised its volume guidance to 350 to 360 million tons for the fiscal year, as against 310 to 320 million tons earlier, which is a growth of close to 43% on a year-on-year basis. It expects coal volumes to move up significantly along with higher growth in container business, which typically does well in the third and fourth quarters. In addition to that, the integration of Gangavaram Port, change in services at Chennai Port and others should keep the volumes in good momentum in the coming months. The company indicated that September onwards, trade has picked up pace, which is a good sign of recovery. On a larger scale and beyond the current fiscal year, the company has set its targets high. It is exiting from Myanmar, which has been a big issue for the company, accounting for about 5% of its total assets. It's ventured into Sri Lanka, developing greenfield port, and has big plans in the warehousing business through organic as well as inorganic routes. It also intends to monetize port-linked land and assets worth about 1,000 to 1,500 acres of land to develop industrial hubs and solar facilities. The integration of Gangavaram Port, Sarguja rail lines and development of Dighi Port is expected to make higher contribution in the coming months. Moreover, it has set its eyes on acquisition of Concor, which is seen around April 2022. For this, the company has already prepared and accumulated funds to the tune of 10,000 crores. It expects another 8,000 crores of free cash flow from the business, and as a result, we see very limited chance for increase in debt even after the acquisition of Concor. Considering the strong pickup in core business, cash on the books and larger growth plans for logistics, ports and other segments, the stock that's trading at 19 times its FY23 estimated earnings offers a good investment opportunity. Especially the acquisition of Concor could lead to a re-rating of the stock.